The S&P 500 has been with us since 1957. It is one of the most popular benchmarks, and when people talk about beating the US stock market, they're usually talking about the S&P 500. But if you look a little closer into the S&P 500, you will see that 60% of the companies have roughly a 10% year-to-date loss, or even worse than that. You'll also see that more than 300 companies in the S&P 500 have year-to-date gains below 5%. And you will also see that approximately 150 of those companies are down year to date. So there's a lot of dead money floating in the S&P 500, which is why people have looked at other ETFs in order to outperform the popular benchmark. Now, luckily, there are several ETFs that have delivered higher gains than the S&P 500. And these three ETFs, yes, they've done that. And they also have portfolios that suggest they can continue to do it in the future. So let's get into the first ETF on this list. It is the Invesco S&P 500 Top 50 ETF. So this ETF, the approach is you look at the S&P 500, that benchmark is based on the top 500 companies by market cap. Now, there are some requirements such as being profitable within the most recent quarter, being profitable in the trailing 12 months in order to be included in the S&P 500. So some high-flying stock like a $100 billion market cap isn't profitable. That's why you don't see it in the S&P 500. There are requirements to go a little bit beyond market cap. But overall, the index is way by market cap. So what the Invesco ETF does is instead of taking the 500 biggest companies, it only focuses on the 50 largest companies within the S&P 500. So addition by subtraction is how the fund works, and it has worked quite well because the year-to-date, the annualized return for the fund's 18.53% over the past 5 years. It has a 0.2 expense ratio, which means you are keeping most of the money that you are putting into the fund. The fees are relatively low if you're seeing a 0.2 expense ratio, and you're also getting a 30-day SEC yield of 0.83%. So you are receiving some dividends just by holding on to this fund. Now, one of the things you will see if you look at the holdings of this fund is it is filled with Magnificent Seven stocks. This is a common occurrence for any index or ETF that looks at the largest companies and weighs them by market cap. You see this play out in the S&P 500. You see this play out in the NASDAQ Composite. And you also see this play out in Invesco's S&P 500 Top 50 ETF. So these seven stocks make up roughly half of the assets within this ETF. So that's something to keep in mind. And it is a common trend when you see ETFs outperforming the S&P 500. So given the large focus on Magnificent Seven stocks, it's not surprising to see that roughly 43% of this ETF's total holdings are in the tech sector. Furthermore, it has outperformed the S&P 100 index, which takes the idea of the S&P 500, but let's just boil it down to the top 100 companies. So it does seem like a consolidation approach instead of diversifying across 500 holdings has been the better approach. But the second ETF on this list really takes the idea to the next level, whereas there's some portfolio diversification going on beyond the Magnificent Seven stocks for the S&P 500 and for Invesco's S&P 500 Top 50 ETF. What we have as the second ETF on this list is the Roundhill Magnificent 7 ETF. It is exactly what it sounds like. It only has the Magnificent 7 stocks within its portfolio. There is no room for an eighth stock. There is no room for 50 stocks. It is just those seven. And the fund rebalances its holdings each quarter to ensure that there is equal weight among the Magnificent Seven stocks. Because if one of them runs off, like let's say Google has a really good earnings report or something like that, that stock's going to make up a larger percentage of Roundhill's ETF. So what they'll do at the end of the quarter is they'll trim their Google position and they'll spread that across the other Magnificent Seven stocks, especially ones that may have fallen behind in the sense that their returns haven't matched up with the top performer, and they will redistribute so that it's evenly balanced across the entire portfolio. The focus on just those seven stocks instead of having 50 has worked out really well for the fund. The 1-year returns approximately 50%, and we don't have data on 5-year returns or 10-year returns annualized because this is a relatively new fund only introduced in 2023. The 30-day SEC yield is 2.34%, so there is a dividend that is coming for investors who put their capital inside of this fund, and it has a 0.29% expense ratio, which isn't that bad, especially considering the returns that are coming out of this fund. Our final stock on this list has been the top performer over the past 5 and 10 years. It is the iShares Semiconductor ETF. This ETF, an easy way to just describe why it's outperformed so well is just early exposure to NVIDIA. The ETF, it focuses on semiconductor stocks, so the artificial intelligence chips, any tailwinds for that is going to result in more gains for the iShares Semiconductor ETF. Broadcom and NVIDIA are the 2 largest positions, make up roughly 17% of the fund's total assets. But it's not just some AI boom that is bringing this fund to popularity. In fact, the annualized return is 31.44% over the past 5 years and 25.40% over the past 10 years. So it has a really good history of outperforming the stock market. However, this isn't a diversified ETF. There are 35 holdings, so it's not just Broadcom and NVIDIA. You've got other semiconductor stocks in there, but you're not getting exposure to other sectors. Like if you want an ETF that's going to give you some exposure to finance, some exposure to industrials, some exposure to healthcare, some exposure to all these other sectors, this isn't the ETF for you. So one of the ways you could approach this ETF is you could get shares in it if you want, but then you may want to look into another ETF for additional diversification. The S&P 500, it gives you diversification across a broad range of holdings. Granted, the Magnificent 7 is still the largest component of the S&P 500, but it's a little less pronounced for the S&P 500 than Invesco's ETF, and especially Roundhill's ETF that we covered earlier. But this is a solely semiconductor play. It's not something that gives you broad exposure to the entire stock market, so that's something to keep in mind before you consider it. It has a 0.35% net expense ratio. And just to give you an idea on artificial intelligence, because artificial intelligence is the big driver for this fund's current performance. If more companies need to make more investments into AI, that means more chips are going to get developed. So it's good to understand the AI opportunity before getting into this fund. The video you've seen, maybe you've seen the incredible earnings reports that they've posted where revenue and net income are achieving triple-digit year-over-year growth rates for several quarters. But the AI industry at large is still expected to boom 36.6% compounded annual growth for that industry through 2030. That is based on research from Grand View Research. So those are the 3 ETFs to consider. Let me know your thoughts in the comments if you are holding on to any of these ETFs or if you have some other ones in mind. That's all for this video. Subscribe for more, and I'll see you in the next one.